This is a catalytic converter, the metal honeycomb underneath your car that turns toxic exhaust into water and carbon dioxide. Inside this device, there are roughly 3 to 7 grams of platinum group metals, platinum, palladium, rhodium, worth more per ounce than gold. For 30 years, catalytic converters consumed 40% of global platinum production. Every car built, every truck manufactured, every diesel engine assembled required these metals. The demand was structural, predictable, and growing. Auto production went up, platinum demand went up. The correlation was so reliable that analysts built entire forecasting models on vehicle sales data. Last Tuesday, platinum closed at $89 per ounce. $89, not $890, not $989, $89. A price not seen since 1973, when Nixon was president and catalytic converters didn't exist yet. The financial press called it a correction, a technical breakdown, a temporary dislocation driven by algorithmic selling. They used words that suggest the price will bounce back, that supply and demand fundamentals will reassert themselves, that $89 platinum is an anomaly, not a verdict. They're wrong. $89 platinum isn't a correction. It's the market pricing in the death of an industry, and the birth of a shortage that nobody in the investment world understands yet. The shortage isn't in cars. The shortage is in everything else platinum does, and almost nobody is paying attention. Here's what they're not telling you. The platinum price collapse didn't begin last Tuesday. It began in 2021, when electric vehicle adoption crossed a threshold that made internal combustion engines a dying technology. EVs don't have catalytic converters. They don't have exhaust systems. They don't need platinum to clean emissions because they don't have emissions. Every Tesla sold, every BYD delivered, every Rivian and Lucid and Polestar and Hyundai Ioniq that rolls off an assembly line is a vehicle that will never consume a gram of platinum. In 2021, EVs represented 9% of global auto sales. In 2025, they represented 31%. By 2030, projections show 58%. The automotive demand that consumed 40% of platinum production is shrinking by 5 to 7% per year, compounding, with no floor in sight. Mining analysts saw this coming. Investment banks saw this coming. Commodity traders saw this coming. They looked at EV adoption curves, calculated the decline in catalytic converter demand, and concluded that platinum was a stranded asset, a metal tied to a dying industry, a short. So they shorted it. Hedge funds built massive bearish positions. Speculators piled in. The paper market, futures contracts, ETFs, derivatives, became overwhelmingly short platinum. At the January peak, short interest in platinum futures reached 847,000 contracts against open interest of 1.2 million. 70% of the market was betting on lower prices. When that much money is positioned one direction, price moves become self-fulfilling. Every tick lower triggers more selling. Every stop-loss hit cascades into the next. Tuesday's plunge from $142 to $89 wasn't driven by physical platinum changing hands. It was driven by algorithmic liquidation of positions that had been building for 3 years. The price is now $89. The shorts have won. The thesis, platinum demand is dying, appears validated. Except the thesis is catastrophically wrong. This is where the lie becomes unsustainable. The analysts who shorted platinum made a classic error. They modeled what they knew, automotive demand, and ignored what they didn't, industrial demand. They saw the 40% of platinum going to catalytic converters and forgot about the 60% going everywhere else. Platinum isn't just a car metal. It's an industrial metal with properties that no other element can replicate. Hydrogen fuel cells require platinum catalysts. Every megawatt of fuel cell capacity requires 30 to 40 grams of platinum, 10 times more than a catalytic converter. The hydrogen economy that governments are subsidizing with hundreds of billions of dollars depends entirely on platinum availability. Glass manufacturing requires platinum crucibles. The LCD screen you're watching this on was made in a platinum vessel. Every window, every fiber optic cable, every laboratory beaker requires platinum equipment that wears out and must be replaced. Petroleum refining requires platinum catalysts. Every barrel of gasoline, jet fuel, and diesel is processed using platinum-based chemistry. Refineries don't close because EVs exist. They continue operating to fuel planes, ships, trucks, and the billion internal combustion vehicles still on the road. Chemical production requires platinum catalysts, silicones, nitric acid, pharmaceuticals, industrial processes that have nothing to do with automobiles and everything to do with modern civilization. Medical devices require platinum components, pacemakers, stents, electrodes, cancer treatments. applications where biocompatibility matters and platinum is irreplaceable. The 60% of platinum demand that isn't automotive didn't disappear, it grew. Hydrogen fuel cell capacity is scaling 40% annually. Glass production is expanding with every new display factory. Chemical demand is steady. Medical demand is growing with aging populations. But here's the problem. Platinum production isn't growing, it's shrinking. The math that traders missed changes everything. South Africa produces 72% of global platinum. The mining industry there is in crisis. Electricity blackouts, load shedding, shut down mines for 8 to 12 hours daily. Aging infrastructure requires capital investment that mining companies can't justify at $89 platinum. Labor costs have risen 60% since 2015, while prices have fallen 70%. Anglo American Platinum, the world's largest producer, announced in November 2025 that it would close 3 shafts representing 450,000 ounces of annual production. Impala Platinum followed with a 200,000-ounce reduction. Sibanye-Stillwater cut 180,000 ounces. In 6 months, 830,000 ounces of annual supply, roughly 12% of global production, was removed from the market. This is the supply response to $89 platinum. Not investment in new capacity, closure of existing capacity. Every mine that shuts represents platinum that will never be produced, from deposits that took millions of years to form and billions of dollars to develop. At the same time, hydrogen fuel cell demand is adding 400,000 ounces of new annual demand. Glass production is adding 150,000 ounces. Chemical and medical applications are adding 200,000 ounces. Total new demand, 750,000 ounces per year. Supply reduction, 830,000 ounces per year. The market moved from rough balance in 2024 to a deficit of 1.58 million ounces in 2026. At current consumption rates, above-ground platinum inventories, the stockpiles held by refiners, fabricators, and exchanges, will be exhausted in 14 months. 14 months. And the price is $89. When physical markets diverge from paper markets, the paper market eventually loses. The shorts who drove platinum to $89 did so by selling contracts, promises to deliver platinum at future dates. Those promises assume platinum will be available to deliver. At 1.58 million ounces of annual deficit, with inventories depleting monthly, the platinum may not exist when those contracts mature. This is the setup for a short squeeze of historic proportions. At 11:15 p.m. London time on Wednesday, the London Platinum and Palladium market reported that physical platinum for immediate delivery was trading at a $47 premium to futures, $136 per ounce versus the $89 futures close. That's a 53% premium for metal you can actually hold versus metal promised on paper. Physical buyers, fuel cell manufacturers, glass producers, chemical companies don't care about futures prices. They need platinum to run their operations. When futures say $89 and physical says $136, they pay $136. When physical supply tightens further, they'll pay $200. When inventories approach zero, they'll pay whatever it takes. The shorts are on the other side of this equation. They sold contracts at $142, $120, $100, expecting to buy back at lower prices. The price is now $89 on paper, but the physical platinum they need to settle those contracts costs $136 and rising. Every short that attempts to cover discovers that the platinum doesn't exist at the futures price. They must bid for physical metal. Their bidding drives physical prices higher. Higher physical prices eventually drag futures prices up. The squeeze begins. Less than 60 days remain before the March futures contract expiration. Open interest in the March contract is 312,000 ounces. Deliverable inventory registered with the NYMEX is 187,000 ounces. If even half the contract holders demand physical delivery, there isn't enough platinum to satisfy them. The mechanics are identical to what happened in palladium in 2019, when a supply deficit drove prices from $800 to $2,800 in 18 months. Platinum's deficit is larger. Its inventories are lower. Its supply response is more constrained. The squeeze, when it comes, could be more violent. While one side shorts, the other side stockpiles. China's behavior in platinum markets tells you everything about who understands the real supply picture. Chinese imports of platinum have increased 340% since 2022. Not for jewelry. Chinese platinum jewelry demand has actually declined. For industry. For strategic stockpiling. For fuel cell programs that Beijing is subsidizing with $50 billion in direct government investment. At 3:45 a.m. Beijing time on Thursday, customs data showed that China imported 89,000 ounces of platinum in December, a single-month record. They're paying the $136 physical price, while Western traders celebrate the $89 futures price. They're accumulating metal that will power their hydrogen economy, while Western speculators bet on a future where platinum is worthless. Japan is doing the same. Toyota's fuel cell vehicle program requires 300,000 ounces of platinum annually at full scale. Panasonic's hydrogen storage systems require another 150,000 ounces. Japanese trading houses have been quietly accumulating physical platinum for 3 years, building inventories outside the visible exchange system. The shorts are selling to buyers who will never sell back. Every ounce that moves from Western ETFs to Asian industrial consumers is an ounce removed from the deliverable float. The pool of available platinum shrinks, while short interest remains at record levels. This is the trap. This is the squeeze waiting to happen. And $89 per ounce is the price that lures the last shorts in before the door closes. This is what a mispriced market looks like before repricing. The investment narrative says platinum is a dying metal. The industrial reality says platinum is a strategic metal entering a supply crisis. One of these is true. The price will eventually reflect which. Some will look at $89 platinum and see confirmation that the bears were right. Will trust that the market is efficient. Will assume that if platinum were really facing a shortage, the price would already reflect it. These are the same voices that said $20 oil was the new normal in April 2020. That said natural gas would never recover from pandemic lows. That said uranium was worthless until it tripled in 18 months. Commodity markets misprice supply crises until the physical shortage becomes undeniable. Then they reprice violently. Others will notice the premium between physical and paper. Will track the mine closures. Will calculate the deficit. Will observe Chinese stockpiling and Japanese accumulation, and the fuel cell demand that's scaling 40% annually. Will recognize that $89 platinum finances no new supply, while demand grows by 750,000 ounces per year. The informed are not predicting when the squeeze happens. Timing squeezes is for speculators who enjoy losing money. What the informed recognize is the setup. Record short interest, depleting inventories, physical premiums above 50%, supply declining while demand grows, a price that reflects a thesis about automotive demand while ignoring industrial demand that dwarfs it. This is not financial advice. This is not a recommendation to buy platinum futures or mining stocks or physical bars. This is simply an observation about what happens when a market prices one narrative while the physical world follows another. The shorts see a metal with declining automotive demand trading at multi-decade lows. The industrialists see a strategic input for the hydrogen economy trading below production cost. Both can't be right. The resolution will be determined not by chart patterns or technical analysis, but by whether the platinum exists when fuel cell factories need it. 14 months of inventory, 60 days to March expiration, 70% short interest, 53% physical premium. The numbers tell a story that $89 doesn't capture. The story says shortage. The story says squeeze. The story says a price that makes no sense today will make perfect sense when the platinum isn't there. $89 is either the opportunity of a decade or the confirmation of a dying market. The fuel cell factories powering up across Asia suggest which one it is.